Now, looking at the markets and what does this all mean and what do we do in this kind of environment, you can see last year S&P was up almost 14%. It's added about another 1% so far this year. So you can see growth in the markets have eased off a bit. It's certainly a lot more volatile. Canada was up 10.5% last year. We've added about another 2.6%. So a little bit better than the U.S., but still, fairly low compared to last year. But overall, it's been a very strong market. And last year and over the last 6 years. In fact, it's been a bull market for the last 6 years. And over the past 85 years, we've had 26 bull markets. This has been one of the strongest and longest. The fourth longest, it started in March of 2009, and it's up 206% during that time frame versus an average bull market of 106%. So when people look at the market and they look at how long this bull market's been going on, it is a question of how long before the bear pulls the plug on this market. The other pushback we get on the market is valuations. And you can see from this graph, it's showing price-earnings ratios of the S&P 500. They average about 14 times. Right now, we're above 17 times. So above average. But I would maintain not that much above average and certainly not to peak levels we saw in the tech bubble. The other concern people would have is what's going to happen to the market if and when the U.S. starts to raise interest rates. So with that, when the U.S. starts to raise interest rates, is that going to cause the market to go down? So one of the things, what this graph is showing you, is estimates of where the Federal Reserve governors who vote on where interest rates are going to be, all their estimates are averaged into that brown line. The blue line is showing where the market thinks interest rates are going to be at the end of 2015, 2016, et cetera. So that the federal funds rate, the Federal Reserve believes at the end of 2015, the federal funds rate is going to be 1.13. The market thinks it's only going to be 0.5%. In 2016, the Federal Reserve thinks they're going to raise interest rates to 2.5%. The market thinks it's only going to be 1.35%. In 2017, the Federal Reserve thinks interest rates are going to be close to 4%. The market thinks it's only going to be 1.84%. This is a problem because you can see the market doesn't believe interest rates are going to go up anywhere near where the Federal Reserve says they're going to increase rates. If the Federal Reserve is right, the market's going to have a problem with that, and you're going to see some volatility. So it's a question, who's right? We think the market's right and the Federal Reserve is wrong. And why? Well, one of the reasons is what we saw before when we're talking about the dollar and interest rates. There's a limit to what the U.S. can let interest rates do and how strong they can let the dollar go in a global market. So we don't think you're going to see rates go up as much as that. And in fact, if we look in January, this is now, the green line, that's now where the Federal Reserve thinks interest rates are going to be, such that now they don't think, they're almost the same at the end of 2015 as where the market is. They think interest rates will be 1.88% at the end of 2016. The market's around 1.25. And by 2017, the Federal Reserve thinks rates will be just over 3%. And the market's about 1.8%. We think that gap's going to continue to narrow, and we don't think you're going to have that big interest rate surprise. The other thing now on valuations, yeah, stocks are high, and they're not cheap. But look at the valuation of other asset classes. And the dark line, U.S. stocks, but if we turn around the bond yields and turn them into effectively a PE multiple and compare them to stocks, you can see that high-yield bonds are higher than stocks, and corporate bonds are even higher. So given where interest rates are, bonds are expensive. We think that is an area of market that I would be more concerned of from a valuation point of view. So stocks aren't cheap, but they're cheaper than bonds. And there's an expression in the market right now, it's called the TINA trade, and that stands for there is no alternative. So you don't like stocks, you think they're too expensive, where are you going to put your money? So that, in that environment, in a stronger U.S. economy, stocks still look attractive. Don't think bonds are expensive? Well, this is a graph showing historically where interest rates have been over time. This is going back to 1756, and you can see how low rates are. They have never been this low. Now, If you don't think this is a long enough history, this one is going back to 3000 BC. And it's showing rates are really low. Now, I don't vouch for the authenticity of these returns, but believe me, the bond market's expensive. So we still like stocks. We still like U.S. stocks. We like Canadian stocks that have exposure to the U.S. Specifically, sectors we like: healthcare, consumer, again, going to that consumer confidence and consumer spending, the recovery of the consumer in the U.S., industrials, including technology, and specifically companies that have direct exposure to the U.S. economy, and also financials. If you believe the U.S. economy is going to get better, you have to like financials. The one thing I would say, though, it's a crowded trade. And what I mean by that, a lot of money has flowed into the U.S. A lot of money has flowed into the U.S. dollar. We would expect to see some volatility around this trade. We would expect to see periods of time where you see that reverse. But I think the medium to longer term trend is still very favorable for U.S. stocks and the U.S. economy. So let's wrap it up. I think this is a good summary slide because, stronger stocks, cheap oil, and better jobs, it's all a very good picture. So we think this two-speed economy is going to continue, stronger U.S. growth. We think that favors the U.S., but we would say, volatility is going to increase. So it's not going to be like we've seen the last few years. There is going to be some ups and downs in the markets. We think interest rates are going to rise, but we think it's going to be slowly and contained. We think it's going to be less than what the Federal Reserve says. And we think it's going to be, mainly because it's capped by deleveraging. All global economies still need to delever, and we think there's that aspect of the currency war. Nobody wants their currency to go up by too much in this environment. And in this environment, we still think equities make more sense than bonds. But we would highlight that there is more than just stocks and bonds. There's a lot of different asset classes, like David highlighted, that we feel diversification is really the way to play this kind of market environment. And John's got some great slides on that. And I can pass it over to John, or I can play that entire Seinfeld episode for you. So up to you. I think we'll go with John. Thank you.